Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by returning guest Rick Rule, President and CEO of Rule Investment Media. Rick, how are you this morning?
Very well, thank you. Thank you for having me back on. I enjoy these conversations.
It's always a pleasure to be able to speak with you and have a chat with you. And I thought the best place to start today was we're recording this at the end of July. I appreciate that the Rule Symposium was held over in Boca Raton in Florida earlier on in the month. I just wanted to check in and see how that went and what feedback you've got from that so far.
The feedback has been very gratifying. It was overwhelmingly positive. We've been putting on this symposium. Some people tell me for 30 years. I don't remember that far back, but for a very long time. And I can say honestly and easily that this was the best one we've done, which is great. The symposium has stood the test of time. One of the reasons why is a very large coterie of returning attendees, a sort of nucleus of people who understand what the symposium is about and use it for that, a culture, if you will. Yes, we had great big picture macro people, not, by the way, journalists or anything like that, but rather people who shape the institutions that they now comment on or criticize. Jim Rickards, talking about the intersection of Wall Street for Main Street. How would he know? Well, he was Chief Counsel for Long-Term Capital Management, whose failure damn near brought down Wall Street. Daniela DiMartino Booth talks about the structure of Wall Street as a former partner at Goldman Sachs. I'm sorry. She talks about the Fed as a researcher at the Fed. Nomi Prinz talks about Wall Street as a former partner of Goldman Sachs. You get the picture. Players, not commentators. Then we always have investors who are not new to the space, but rather to be a legendary investor with us, you need to have 30 or 40 years of experience in good markets and bad. And we had that. Jonathan Goodman, 50 years experience. Frank Giustra, 40 years experience. Adrian Day, 45 years experience. Through good markets and bads, people who've seen it before. Importantly, Robert, every exhibitor at our conference has been vetted. If we don't own shares in them, they don't exhibit. No guarantee, sadly, that because I own stock, the stock goes up. But at every other conference in the world, the qualification to be an exhibitor is a check that cashes. Sometimes a tough test, but not tough enough for me. So it was really great. It's also worth noting live attendance this year was like 600, up from 400 a year ago. Live stream attendance from almost 40 countries. I don't know exactly how many countries yet. This year exceeded 1,400, double last year's total. So the audience, of course, we would like everybody there live because there's lots of information that's not verbal. There's lots of discussions that take place around the coffee urn, or better yet, around the bar, that aren't recorded. Probably the better for that you miss. But the truth is that we serviced over 1,400 people from almost 40 countries with an absolute irrevocable money-back guarantee. And thus far, we've had to make one refund out of 1,400 people, despite a technical glitch the first day. So I'm just delighted with the way the conference worked.
Oh, good. I'm glad, and it's what I'll do for those that are not necessarily familiar with the Rule Symposium. I'll put links to that in the show notes on YouTube and Substack, just so people can have a look. So I think people can still do the recordings, can't they?
I should note that, yeah, those recordings are for sale with a complete money-back guarantee. If you play the recordings and you don't think that they're worth the price I charged, you email me. I'll give you your money back. We've had absolute money-back guarantees at Rule Investment Media for 30 years. We've had to refund less than one-tenth of 1% of the tuitions that we've charged, but that's your guarantee that we're bent on giving you your money's worth.
As mentioned, I'll put links to all of that in the show notes that come with this. I thought I'd just start there just because of when we're recording this. I thought I'd ask you, and I'm glad it went well, to be fair, Rick.
Yep.
The second thing to ask you again is we are sort of at the start of earnings season? Because last time you were on the show, we spoke about the overall what's going on with gold, silver, and the miners. We saw last Thursday Newmont's results, and they blew, I think, most things out of the water. I think that probably sets the precedent for the rest of Q1 earnings. Are you looking out for anything in particular, or do you reckon it's just going to be quite good across the board? And then do you think that might start getting retail involved, or do you think we're a bit of a way off from that?
I think retail is involved. The last 7 or 8 financings I've participated in have all been oversubscribed. I'm a fairly well-known investor. Companies tell me that it's of benefit to them to have me on their shareholders roster. And despite that, there's enough money on offer that my subscription interests have been cut back. That tells me that there's money in the space. The fact that our own virtual attendance at our conference doubled tells me that there's monies in the space. Now, that earnings result from Newmont was very, very good. It ended 8 straight quarters of misses on all-in sustaining capital costs. It's very important to understand that. Newmont decided 2 years ago that they were going to tackle the rise in all-in sustaining costs by selling off all of their tier 2 operations after the acquisition of Newcrest and focusing capital, love, and attention on tier 1 assets. And this quarter suggests that they were successful. In addition to that, they had forecast to raise about $2 billion through asset dispositions. They've now raised almost 5 from asset dispositions. This does 2 wonderful things. It allows them to buy back stock if they want to, and it gives them lots of capital to invest in their remaining high-quality opportunities. It also frees them from trying to figure out how or what to do with 12 assets that were less than material to Newmont. I hope, please remember that I said hope, that this improvement extends to the rest of the sector. One would hope that the increase in gold price relative to the increase in input costs will allow other companies to enjoy the same margin expansion than Newmont had. For the best of the best gold producers, this delta between increasing gold prices and less rapidly increasing input costs began to occur 18 months ago. If you look at companies like Lundin Gold, like Alamos, in particular, like Agnico Eagle, you can see that what occurred at Newmont is hopefully part of a broader trend. The $64 billion question, of course, is how far down the value trail and how broadly does this occur? And I think this quarter will begin to tell the stories. What happens at Pan American Silver, as an example, a very technically competent second-tier miner? What happens at Barrick? What happens at Kinross? This will be a very interesting season. I don't think that you will see broader participation among either Wall Street or Main Street until we have 2 or 3 quarters of margin expansion. What we will see is a deeper participation by people like yourself and myself who are already interested in the sector.
I think the other thing to put on Newmont as well, and again, I speak just from sometimes having a quick Google and asking Google questions and so forth, is that it's not necessarily renowned for being the best managed company, despite how big it is, not the best managed company. So the fact that Newmont has produced X, Y, and Z in its results, that could bode well for other companies that, should we say, have got a more efficient management system.
That might be true, or it might be that Newmont's management is finally focused on the generation of per share value rather than heft. Remember that Newmont is a company that grew inorganically for a long time. They grew by acquisition. And the consequence of that is that they became a hodgepodge of assets, some good, some not so good. The important decision that they made, I think, is the liquidation of their tier two assets to focus on tier one assets. While that decision was way overdue, at least it was made. And it may be two things. It may be, as you suggest, that given that their returns on capital employed and their capital allocation decisions over 20 years were lousy, it may be that companies that made fewer mistakes will have a less long road to recovery. It may also be that institutional investors or others focused Newmont's management on the task at hand, and there has been qualitative improvement internally at Newmont.
I guess we will see what the Q2 results look like a few months down the line in order to try and put more pieces of the puzzle together, so to speak.
Certainly, at the conference and online, I have now for three times interviewed publicly the CEO of Agnico Eagle. And there is a lot to be said for the culture of success. What you hear particularly from Agnico Eagle, they've had three CEOs in 55 years on Earth. There is a culture of continuity there. There is a culture of measuring their progress in terms of net present value on a per share basis, not on a company-wide basis. Mm. There is a culture there that, despite being the most profitable gold mining company on earth, they don't have a corporate jet. There is a culture of focusing on treating their employees as partners and contributors. The consequence of that is that their turnover is less than half the industry average, which means that their lost time injuries and their fatalities are lower. It also means that their training costs are lower because you don't have to train somebody who's been with you for 12 years. Mm. The progress that we're looking for out of Newmont will be indicated by a quarter. It'll be demonstrated by a decade.
A lot is happening in this space. When he said three CEOs in 55 years, I might get destroyed for this reference. Sounds very similar to, I say, the Pittsburgh Steelers, because they're very renowned for having their head coaches for a very long period of time for the consistency purposes. NFL aside, that's what we've seen so far. Rick, when we last spoke, which was about September, I think, last year, silver it was around about $30. We're now seeing it around $40. Obviously, it's been quite a big difference there. Is that enough to get you excited, or we're still at the start of a potentially much bigger move higher?
I was more excited 18 months ago when silver was hated. I think what you've seen in silver is not so much partly you're seeing a reaction to the gold price. That's the way bull markets work. But you're seeing something else. You're seeing at least a neutral attitude rather than hatred towards silver. You may remember the so-called silver apes, the idea that silver became almost a meme and became extremely popular. There was going to be a silver squeeze. And you had a bunch of ma's and pa's, or in this case, probably teenagers living in the basement, who crowded into the silver space thinking they could do a GameStop. They were thinking collectively that they could outsmart Wall Street. They found out how smart they were. They got their ass kicked. They got obliterated. The consequence of that is that they went to their favorite playground, Google or X or wherever, and expressed their hatred for silver. And the consequence of that is that silver became, in popular parlance, a four-letter word. What we've seen is the reduction of hate towards silver. We haven't seen favor towards silver. Silver historically performs in the last half of a precious metals bull market. The three precious metals bull markets that I've had the privilege of living through have followed predictable patterns. The initial buyer is a fear buyer. And the first movement in gold is actually a dead cat bounce. Gold is so far out of favor that all the sellers have sold, and any buying comes into a market with an absence of sellers. That's the first pop. Then you have the fear buyer, the buyer who buys gold as a consequence of the fact that he or she is concerned about the deteriorating of their purchasing power in conventional savings assets. This doesn't move the gold stocks because these aren't greed buyers, these aren't stock buyers, these are fear buyers. In this bull market, that was exacerbated by foreign central banks who were forced to buy gold because of the weaponization of the US dollar.
Hmm.
It took a substantial period of time for the momentum in the gold price to find its way into the balance sheet and the income statement of the gold companies. The last 18 months, you've seen a move of the biggest and the best in the gold mining companies. This is precisely the trajectory that's happened in the last three bull markets. At some point in time, the momentum established by gold and then the gold stocks attracts the generalist investors into the precious metals mining space. And perhaps because of its lower unit cost, when that happens, silver begins to outperform gold, and it outperforms gold handily. I'm not really sure why that happens, Robert. I just know looking back at 50 years of the history that I've experienced, that it happens. It's important to note that people say, well, silver's at 40 now, and the all-time high is only 50. But when you talk about that, you're talking about nominal dollars, not real dollars.
Hmm.
$50 US silver in 1981 in constant dollars is much more like $150. I'm not suggesting that silver is going to go to 150 or that it isn't. I'm just suggesting that capping your upside on a nominal dollar basis is stupid.
And with reason, that's one of the joys of, again, speaking to yourself, like you said, with 50 years so forth of experience, and you've seen this play out before. Again, just to dive into that knowledge of, where are we in the current cycle, and then what's likely to happen. Again, digging into that, pardon the pun, digging into that knowledge is incredibly useful, not just for myself, but obviously for the audience as well.
Thank you. I I hope that I give you the ability not to repeat my mistakes.
Oh no, but a pleasure as always, Rick, to be perfectly honest with you. So I think you've just laid out where we are, but I just want to put it in layman's terms. So with everything you've experienced before and where we are now, roughly where are we in the cycle? And if you had to put a time frame on it, uh, given all the other geopolitical and currency issues going on, what do you think the roadmap is moving forward?
Let me disclaim that, Robert. Um, I think that we're in for a particularly robust precious metals market because I think the challenges that face conventional savings instruments are greater than other people do.
Mhm.
We've been conditioned, you and I and our listeners, by the most benign period in economic history, the period 1982 to 2022. A wonderful time. Uh, Great demographics, declining real and nominal interest rates, US dollar hegemony, just truly spectacular. Freer trade, that's over. And the excesses that happened in that period must be paid for now. While that bull market occurred, and while it was a good thing, we hit a lot of sin. In the US, on balance sheet debt, federal debt to GDP, rose from 32% in 1982 to 130% in 2025. Off balance sheet liabilities, which is the net present value of entitlements in the United States, old folks like me, grew from about 90% or 95% of GDP in 1982 to 400% of GDP in 2024. We have been through a period like this before. It was called the 1970s. There's two ways out of this dilemma. Politically, you can't raise tax too much and you can't cut benefits. So what you have to do is inflate away the net present value of the obligation. In the period of the 1970s, the Office of Management and Budget, the forerunner to today's Congressional Budget Office, says that the US dollar lost 75% of its purchasing power in 10 years, which is to say, a thousand 1980 dollars bought you 250 1970 dollars worth of goods and services. My base assumption is that the US dollar will lose 75% of its purchasing power again in the 10 years in front of us, which means that the real value of our off-balance sheet liabilities, our entitlements, will decline by 3/4. To me, that's the only way out of the problem. If that happens, it wouldn't surprise me, remembering that in the decade of the 70s, when the US dollar lost 75% of its purchasing power, that the gold price went up 30-fold. I'm suggesting that the increase in the gold price is not unlikely to mirror the decrease in the purchasing power of the US dollar.
Mm-hmm.
If that were to happen, arithmetically equally, the gold price in nominal terms would go up fourfold. Let's say that's excessive. Let's say it goes up threefold. The impact of that on both the value, but also the perception of the value of the gold shares would be dramatic.
Uh-huh.
In the decade of the 1970s, the gold shares outperformed gold by about 2-1. Little companies like Coeur d'Alene Silver ran from 10 cents to $65. Not a typo. With that assumption, and your listeners will need to decide whether they think that my assumption about the deterioration of the purchasing power of the US dollar is accurate. But if you agree with that assumption, I would suggest that we're about a quarter or a third of the way through a precious metals bull market. The commodity has moved. Truly, it has moved.
Mm-hmm.
As recently as the year 2000, gold was $250 an ounce. So it's up what? Tenfold? 12-fold?
12, 13, 14,
And just
14,
recently, the
yeah.
last 18 months, the second sector to move is the best of the best. The Franco-Nevadas, the Wheaton Precious, the Agnico Eagles. They've had really nice moves. 65% for the laggard, 110% for the winner. Pretty good. The market now moves to the best of the rest. Newmont is rocking now. Kinross is rocking now. Leadership begins to move from the best of the best to the best of the rest. And what happens is that valuation anomalies form. The larger, more liquid companies enjoy a greater influx of, as an example, passive and index buying, and they become more valuable relative to their smaller and less liquid peers. The best of the best might sell at 2x NAV, given a constant gold price assumption, while the best of the rest trade at 1x NAV, and the junior producers trade at 70 or 80% of NAV. Two things happen there. Valuation arbitrageurs, guys like me, begin to take some profits in the best of the best, and they reassign the capital to companies that are selling at lower multiples, knowing that either the multiples converge or the big companies take over little companies. And the second thing is that the big companies do take over the little companies as those valuation anomalies persist. I would suspect that if this gold bull market, pardon me, precious metals bull market follows its course, that we are likely a quarter of the way through the precious metals bull market, very early on. Remembering back to the decade of the 1970s.
There's a lot of room to run then, and I think that if we're conservative on the gold price, so as you say, you mentioned, 4x. Let's just say 3x for argument's sake. Well, 3x brings us up to, let's just call it $10,000 for a round number.
Correct.
And as you highlighted earlier on, if gold's making that first move and the gold miners making that move, then silver will have to follow up. Otherwise, that gold silver ratio is going to be a ridiculous number. So silver surely has to then follow. And I think that's where I think quite a few people start to get very excited about that move, as you've highlighted before.
Well, a few assumptions or a few modifications that my assumptions may be wrong.
Mm,
You know, it may be that our technological innovations are such that our individual creativity overwhelms our collective stupidity, and we get out of this. It may be that because of technology that we're becoming a less capital intensive world,
mm.
and my concerns are ill-founded. I don't believe that to be true, by the way, but I'm throwing that up to your listeners because I don't want them to say that this is an inevitability. This is a probability we're speculating on. If past is prologue, then at some point in time in this market, you will see silver dramatically outperform gold. That has occurred in my lifetime when the generalist investor becomes attracted to the precious metals narrative. And that has not happened yet. The generalist investor still looks at the outperformance of the S&P 500
Mm.
and said, why would I care about gold when Nvidia is doing so well?
Yes, very, very true. Rick, that I know there's an offer you'd like to make to the listeners at the end, and we'll speak about that at the end. But I just wanted to bring AI into the conversation quickly because I know that on previous podcast appearances with other people, you've mentioned that AI might actually make your job easier from an investment point of view in terms of how long it takes to analyze companies. That's thought it'd be a good question to ask. And again, how will AI, if it's making your life easier, how can it make lives easier for other people when it comes to deciding potentially which companies to look at or to potentially invest in?
You have to know enough about the mining industry and enough to know enough about the data sets to ask AI intelligent questions. AI at its worst is merely a search engine, which is to say it aggregates misinformation. If you ask AI a non-specific question, it sorts for information among sources like CNBC or CBS or X. In other words, it collects stupidity and delivers them to you. If by contrast, you say to AI, what is the median all-in sustaining capital cost, pardon me, all-in uh, costs for the 50 largest market capitalization gold mining companies in the world and constrain the search to Edgar and CEDAR. In other words, if you ask an intelligent question, AI can give you an intelligent answer. But if you ask it an open-ended question, if you don't know enough to constrain the question that you ask, AI will wreck you as an investor because all it will do is assemble mass stupidity. And there's lots of stupidity out there.
So the emphasis is on the quality of the questions in order to get the best responses possible, which would then help people moving forwards rather than just open-ended nonsense per se.
Many speculators have not taken the time to understand what return on capital employed is. Many speculators have no concept of what weighted average cost of capital is. You need to understand the basics of investing and some of the specifics about mining investing in order to use AI. If you ask AI a stupid question, and most of the questions that are asked of AI are stupid, and you don't constrain it from utilizing stupid databases, you will get stupid output. And if you use stupid output to make investment decisions, you will likely make stupid investment decisions.
Definitely a lot to bear in mind, I think, for moving forwards. And I think the trap that I don't want people to get into is just because of everything that we've discussed, i.e., this is where gold could potentially move based on this hypothesis and so forth. It doesn't then mean that every, put into mining company A, B, and C, that doesn't mean you're going to get 10x. There's still obviously a lot of factors there. Rick, I don't think I asked you
If you
this.
ask
So,
AI as an example,
yeah.
what's the inflation rate?
Mm.
AI will give you the CPI. And the CPI measures inflation to a definition that is not accurate from your point of view and my point of view. The CPI is a manufactured index that has nothing to do with the deterioration of the purchasing power that you enjoy relative to the basket of goods and services that you consume.
Hmm.
The CPI, as an example, doesn't include tax. Now, I'm sure if you didn't have to pay the tax, you wouldn't bitch about the index. But the truth is, if you ask uh, Grok to give you the inflation rate, they'll give you the CPI. They'll give you an absolute garbage answer. If you ask them to give you a range of estimates around the deterioration of the purchasing power of the US dollar, then you get a better answer. But you need to know how to ask the question.
Yes, I totally agree with that. I think that's a lot of food for thought for people to take away as well. The question I was going to ask, I don't think I asked you this last time. Obviously, when people, and yourself included, with when you're looking at your potential mining companies and to invest in and so forth, I've heard different people say, well, region's important or management's important as well. Are there any other particular factors that you look at when you're making your investment decisions?
Well, it's very subtle. The first thing I look at is what I think the liquidation value of the company is, because that explains my downside. In an early stage exploration company, the liquidation value is zero. Uh, who could they sell their claims to, and for how much? And would that money be enough to cover the severance cost of the employees? And the answer is almost always no. So when I go into an early stage exploration company, I understand empirically that my downside is 100%.
Mm.
Uh, you don't invest to lose 100%, but it's interesting to have that perspective. In a company that has had more time on Earth and has answered some unanswered questions about the claims, it might be that the liquidation value, and it's important that the liquidation value not be the market cap of competing companies, but rather the sum of the total that you could realize by selling off the assets to industry. It may be that the liquidation value is 50% of the market capitalization. So then you understand that in the absence of progress, you lose half your money. Not that that should be your goal, but you should understand your upside before you understand your downside. The second question that you need to ask yourself is, what are the unanswered questions in front of the company, which is a different way of saying, what is the company likely to be worth 5 years from now?
Mm.
And how does that vary from the price you are paying for it? Then you need to question your assumptions. Uh, do I care about the opinions of the people who have answered those questions for me? Does the management team have enough specific experience directly related to the task at hand that I assign their answers any credence whatsoever? If the management team is a coalition of used car salesmen and investment bankers, stuff like that, and I'm asking them fairly specific empirical questions about valuation, geology, and engineering, why should I care about their answer? What they know about is selling cars.
Mhm.
Even somebody who has demonstrated success in mining, if that success isn't related to the task at hand, I need to discount their answer. If a person's definition of success is that he or she successfully operated a producing gold mine in Archean, 2 billion-year-old rock in French-speaking Quebec, but the task at hand is exploring rather than producing
Mhm.
copper gold porphyries in 15 million-year-old accreted terrain in Spanish-speaking Peru, the success isn't translatable. And I have to discount my faith in the answer to overcome my lack of faith in the person answering the question.
Mhm.
The third thing I look for is scale. What I've learned in my life, sadly, is that small mines can only ever make you small money, but they have big risks. Big mines, while they have big risks, can make you big money. The idea that I'm going to take a big risk for small money is arithmetically unattractive to me. I don't want to do that. I have a much more charitable attitude towards political risk than I do technical risk, which is to say, I would much rather own a great deposit in a challenging country than a challenging deposit in a great country. I don't discount political risk, but I think political risk is discounted itself in Western countries.
Mhm.
People like you and I, let's just say it, white people, believe that political risk is less when the lies are told to us by white people in English according to the rule of law. It turns out that's not true. My greatest experience with political risk was in the People's Republic of California. I have got higher returns on capital employed, I personally, even after sanctions in Russia, Congo, Sudan, Brazil, than I have in the United States and Canada. Uh, the outliers would be Chile, which hasn't exposed me to much risk and has given me spectacular rewards, and Australia, which hasn't exposed me to much risk and given me outstanding returns on capital employed. But I would ask people to weigh political risk without, or at least with as little as possible, uh, sociological prejudice and frankly, racial prejudice.
Hmm.
When I speculated in the Congo, it was all political risk. There was a war going on. There was AIDS, there was Ebola, there was malaria. But I was able to buy shares of Tenke Mining, which at that point in time controlled the best undeveloped copper mine in the world. The shares were selling at the bottom at 19 cents a share when there was 30 cents a share cash in the treasury. And the people fronting the company, the Lundin family, were probably the best mine developers in the world. The valuation question was fairly stark, or probably the probabilities were fairly stark. I could lose all my money easily. I could lose 20 cents a share. Or, in the right set of circumstances, I could make $5 a share. And I decided that if I could make a series of disaggregated bets where my downside was 20 cents and my upside was $5, that with money I could afford to lose 20 cents on, I should take that risk. Turns out, mercifully, I was wrong. The stock didn't go to $5, it went to 18. But you get the point. Um, I've learned a lot about political risk. When I remember the recent penalty I faced for overstaying my welcome in Russia, which is to say 100% of the value of my portfolio there in suspense. By the way, I can't take any sort of tricky ways to get at that money. I have a bank and organization in the US. So the political risk on this side
Mhm.
prevents me from mitigating the risk on that side. I failed to take into account that my first investment in Russia was Vostok Nafta, a closed-end fund fronted by the Lundins that went 100 for 1. 100 for 1. And the returns on capital employed that I enjoyed in Russia in the 23 years before I got trapped by sanctions was something like 25% compounded annually.
Oh, wow.
So what went away for me was the icing on the cake. I remember that icing on the cake going away. By the way, I remember that vividly. But I need to juxtapose that against my history investing in Russia. And then I need to juxtapose that on my returns on capital employed in the United States and Canada. And all of a sudden, Russia seems less risky.
So I think that's some fantastic examples there. And thank you for dispelling that as well, because I do find that's quite a common thing when I'm browsing around the internet and reading at people. And I've written it as well. And you mentioned Congo and South Africa and whatever. And it automatically can turn some people off where, in fact, they're the exact places you need to be looking for some fantastic opportunities. I think we take things for granted over here, as you said.
When people point out today, and I'm not trying to say it isn't real, there's lots of risk in West Africa. When people point out
Mm.
today what the government of Mali has done to Barrick, which
Mhm.
is basically theft, I like to point out just for fun that back in the early 2000s, when the natural gas price went up well, the government of Alberta, ostensibly a free market government, doubled the gas royalty and included the
Mhm.
severance tax, which is to say legal nationalization. So explain to me what Mali has done that Alberta didn't do. Explain to me what happened in the decade of the 70s in the United States and Canada, excess profits tax. Explain to me what Mali did in the context of the national energy policy in Canada. We just, when I say we, you and I, white people who speak English, tend to be a little more polite about how we steal.
It's true. Uh, Very true. I think just before I ask you about battle banks, I'd like to touch on that subject as well. I think from from a UK point of view, I look at some of the things that's happening at home. And yes, we're not the most resource-rich country in the world. I'll hold my hands up to that. But we're refusing to hand out new oil licenses for the North Sea, which doesn't make sense. We're refusing to go into Lincolnshire to tap into a massive natural gas field. I look over at Canada, who has a lot more natural resources. And again, just to go back to your point, I look at what's happening over there, and I think people need to be prepared for the political risks that we have on our own doorstep with regards to, commodity companies when we're making our investment decisions.
What British investors need to understand is that your country has an enormous reserve of human capital.
Mhm.
The resource finance expertise that exists in London, despite years of being abused by your government, is still a greater resource than is available in Canada and Australia. The human resources in Great Britain are unbelievable. I mean, truly unbelievable. The technical expertise, Canborn School of Mines on down, the financial expertise. So, what the British investor likely needs to do is develop relationships with very high quality British intellectual capital
Mhm.
and invest outside Great Britain. The political reality in Great Britain is horrific. Uh, the like in California or in Canada, the
Mhm.
tendency to vote for free beer and a free lunch, the idea that you don't equate the utility that you generate with the wage that you receive, that you think you do something irrespective of your contribution, is really truly lethal. Really truly lethal. And the British tradition really borrowed from the Germans. The sort of Fabian or Keynesian politics of Great Britain is
Mhm.
tragic. Mercifully, uh, there is a reservoir of intellectual capital and a reservoir of educational excellence rapidly degrading that is the best in the world, simply the best in the world. The British investor, with the possible exception of the Hong Kong investor, British investors in drag, uh, are maybe the least ethnocentric investors in the world. The British investor, my friend Adrian Day is an example out of the London School of Mines. He is equally comfortable investing in Indonesia or
Mhm.
Africa or South America or the United States or, heaven forbid, Great Britain. And the British investor needs to understand that access to that pool of human capital is one of the unsung benefits of living in Great Britain, particularly living in London.
I had the pleasure of speaking with Adrian Day a couple of weeks ago, actually, and he even put in a cricket analogy for me, which I was very happy about. But no, point taken there, Rick, and thank you for explaining that. It's we got to take the good with the bad. And that being said, despite the accent, I find that about 50% of the audience is actually from North America. So let's swing back to battle banks. I know we mentioned it briefly last time, and of course, there could be a lot of potential here for our North American listeners to make use of battle banks. So, what's the latest progress? How are things working, and what's going on?
Well, we tried for 4 years to go in through the front door, which is to say, to charter a de novo bank. Our last bank, EverBank, was 19 months from preliminary application to charter. But times have changed. we, we were 54 months and counting. So we bought a bank, a little bank, to be sure. And now we don't need FDIC approval because we have FDIC approval. We need approval from the Office of Comptroller of Currency, and we need approval from the Fed. By the way, we're negotiating the words of those approvals as we speak for change of business plan, so that we take this little community bank in Uppsala, Wisconsin, and we take it national, or international in this case. We expect approval literally any day. And then it'll take us 90 days or so to get open. We're already experimenting with our internal procedures. This guy named Rick Rule, who doesn't need to buy any more gold, has bought some gold through Battle Bank. I don't need to take out a loan against this gold, but I'll do it to make sure the system works. I'll make a deposit. I'll buy a foreign currency CD. You know, all these things. We don't want to make you mad if we can make me mad. That's probably okay. That's part of opening a bank. It's important when people consider the bank that they think about our last bank, EverBank. EverBank opened in the year 2000, doing things differently. We'll discuss that in a minute. But over 14 years, it grew from $0 to $28 billion in deposits. It's important to note that when EverBank opened, it had zero customer backlog. At Battle Bank, the customer backlog is about 18,000, more than half of whom have indicated to us what service or product of Battle Bank they would like to access. A huge advantage. What services or products are those? Well, first of all, unlike many banks, we pay you interest on your deposits. At one of our competitive banks, they have 16 deposit products, 7 of which pay you no interest. If you're interested in interest, including on your checking account, think Battle Bank. The second is that at Battle Bank, rather than banking in one country's currency, you can bank in 20 currencies. You can bank in pounds. You can bank in Australian dollars, US dollars, Canadian dollars, Argentine pesos, euros, Swiss francs. The choice is yours, particularly if you do business in 2 countries. This is a wonderful feature. If you live your life in 2 currencies, you need to save in 2 currencies. At Battle Bank, you can do that. By the way, you can do it at JP Morgan Chase too. It's just there's a $10 million minimum, which is out of reach for some people. In the US, we have a savings product called an IRA and a different one called a 401k. These are tax advantage savings products. For most competing institutions, those products are receptacles for Wall Street products, for mutual funds, for annuities, stuff like that. At Battle Bank, it's very different. Your IRA is your IRA. Your solo 401k is yours. You can invest in, let's say, a duplex, in a rental property, in a franchise, in any permitted activity. You make the decision, not Wall Street. Huge difference. Huge difference. On the lending side, most of our competitors try to be all things to all people. They lend to 500 businesses, maybe 50 of which they understand. No wonder they screw up their balance sheet. Our first important lending product at Battle Bank will be that we make what are in effect margin loans against physical gold, silver, and platinum and palladium. This is a market that we've been talking to for 50 years. We understand it. We think it's great collateral, not good collateral. We think it's great collateral. But that sets us apart from our competitors too. We're not going to try to be all things to all people. We are going to try to be the bank of choice to self-actualized investors, people who aren't passive investors. We won't even try to be their only bank, but we certainly want to bank their gold and silver. We want to lend to industries like gold and silver brokerages or numismatic dealers or oil and gas companies or mining companies or forest products companies that we understand. We aren't the kind of bank that will, like Silicon Valley Bank or the savings and loan industry, fund 8 or 10 year fixed rate loans with variable short-term deposits, we're not going to get caught in a time spread. We're not going to do that. I watched the savings and loan industry blow up. I watched Silicon Valley Bank blow up. I have no interest in blowing up. So we'll match our assets to our liabilities well. That's really the difference with Battle Bank.
I think there's plenty there for people to consider. And if I'm right in saying, again, I'll put a link to the website in the notes that come with this. So battlebank.com, I believe, is the website for
That's
that.
correct.
So,
That's correct.
uh, Rick, when we last spoke about Battle Bank, I've also spoken to Frank Trotter, who's been on the podcast as well. He
Yep.
mentioned that it would be available initially for those that reside in the United States of America. Is that still the case?
To open the United States and Canada, at Everbank, I think it took us 4 years,
Mhm.
but eventually we were able to do banking business with all of the Commonwealth countries. Well, put differently, with 28 countries worldwide, including all of the Commonwealth countries. So the first logical area of extension for us after the United States and Canada will be to climb through the regulatory hurdles in Great Britain, Australia, New Zealand, and
Mhm.
Hong Kong.
Well, perfect. Well, again, I'll put the link to the website in there. And again, about 50% of the audience listens and watches this podcast from the North America. So hopefully, I urge them to get in touch with yourselves and your team there at Battle Bank. Rick, we mentioned a special offer earlier on. This is something I've taken advantage of twice in the last 3 or 4 years, and I think you've done a great job doing it. The floor is all yours. How can you help people that would like to know more about their mining portfolios and so forth?
If people like the way I think from this podcast, I would invite them to personalize it. Go to ruleinvestmentmedia.com, list your natural resource stocks, mining and oil and gas. Please no crypto, please no pot stocks, please no tech stocks, natural resource stocks only. I will, for free, no obligation, rank them, and I'll comment on individual companies if I think my comments might have value. That's ruleinvestmentmedia.com. List your natural resource stocks. By the way, be a little patient. I'm about 200 rankings behind.
Mhm.
And please, no non-resource issuers.
I would urge people to do that as well. I say I've done it twice in the last couple of years, and I've found that the comments and the insights incredibly useful. So thank you, Rick, for doing that. I'll put a link to that in the show notes as well. I also have here on X, if people want to follow you or get in touch, I've got Real Rick Rule over on X. Of course, we mentioned Battle Bank earlier on, Rule Investment Media. But I think that's everything covered, unless there's anything else you wanted to quickly touch upon before we say our goodbyes.
No, I think that's plenty. Yeah, I think that's plenty. I think the easiest way to benefit directly from me is Rule Investment Media.
Mhm.
A lot of my comments on X have to do with educational outreach, which I do as a director, as an example, for Students for Liberty, as a member of the Atlas Foundation. I try to promote individual liberty and free market economics on X, which is the largest online community in the world. Uh, that amuses me, and hopefully it changes the way some people think about individual liberty. There isn't much economic value to your listeners there. The economic value that I can offer them is all around ranking portfolios at Rule Investment Media, or the 200 hours of free instructional programming at the Rule Classroom, including 6.5 hours on Introduction to Natural Resource Investing, which is securities analysis for amateurs around mining and oil and gas. All free.
Again, I'll link to that in the show notes as well. Rick, it's been an absolute pleasure to have you back on the show. I thoroughly enjoy talking to you and look forward to catching up in 2026.
My pleasure. Hopefully, at some point in time, you'll come to Boca Raton for our conference, or at the very least, attend it via live stream. We look forward to that relationship as well.
Well, thank you very much. On the to-do list for next year, as listeners will be aware, I now am on the North American side living. So I live in Mexico. So it's going to be a lot easier for me to get to. So hopefully next year, if not in person, then uh, online as
Via
well.
live
But
stream.
Rick,
Wonderful.
absolutely perfect. Thank you very much and look forward to speaking again soon.
My pleasure. Thank you.